right, so with that said, and if you're ready to get started with today's webinar, let me introduce Mark Minervini and David Ryan. Take it away.
Okay, let's make sure I'm working here. I'll get my camera on. Okay, can everybody see me okay? I got yelled at before because I was wearing a white t-shirt, so let's put another shirt on here. Dave, you there?
I'm here. How you doing?
I'm good, thanks. Interesting trading day today. Market's closed down. So listen, we're going to talk about the 11 deadly trading mistakes, and hopefully Dave and I are going to try to help you understand how you can avoid those mistakes. And I just want to point out that I would say 95% of all the troubles that you have in the market, all the difficulty that you're going to be experiencing over your trading career, or certainly your learning curve, are going to stem or be traced back to these 11 items that we're going to talk about today. This is really sort of the bulk of where a lot of the troubles come from, and that's why we're going to focus on those. Dave, of course, you've been doing this for a long, long time and made a lot of mistakes, just like I did early on. Just want to, maybe you can real quick just shed some light on the fact that, some people, they get into the market and they just, it's all roses and they think everything's going to be big returns and a lot of fun, and all of a sudden, trouble hits, a bear market, a correction, and they start having all kinds of difficulty. You got to expect to have some troubles and to make these mistakes, right? I mean, it's kind of unavoidable. We have to make these mistakes to learn, right?
Oh yeah, and some people have a longer learning curve than others. I say at least it takes a few market cycles, I think, to really get all this down. And a lot of it comes down to discipline. Are you able to follow rules? And because if you can follow rules, you can avoid a lot of these mistakes. But as you said, you also you have to probably go through a lot of pain and learn from your mistakes so you can go on to do well in the market. That's how I started out. I doubled an account, I lost it all, or almost all of that gain, and then but it forced me to sit down and look at what I was doing wrong. So learn from, you got to really learn from your own mistakes, and we'll go through these 11, and hopefully that will help you cut the time it takes to get a hold of this approach.
Yeah, and I'd be willing to bet that Dave and I made every one of these mistakes, and we certainly can relate to all of them, and so will you. And if you haven't yet, you certainly will. So let's start off with let's dive right in and talk about the first mistake that most traders make, or all traders at some point. We all make these mistakes at some point, and you're not going to not make mistakes. All right, the real key is, and people think someone like myself that I'm right more than maybe someone else. Actually, I lose on a lot of trades and I make lots of mistakes. It's just I don't make big mistakes. It's sort of like a professional golfer. Tiger Woods may have a bad round every now and then, or a bad hole, but he's not blowing up on a regular basis like an amateur. Is going to make some grave mistakes. So it's all about minimizing them and getting them down to where they're as small as possible. It's really getting these mistakes to be small, but you're going to make lots of mistakes. So I think everybody can relate to FOMO, right? Fear of missing out. So I want to talk about that, and forcing trades. This is something that I've talked about. For those who know me know that my two big rules are no forced trades, no big losses. So let's talk about forced trades. What does that even mean? So a forced trade is doing something that is beyond your plan, or changing your plan, going into the day, and maybe you have a few stocks that you've planned on buying if they hit certain prices and meet certain criteria, and instead, in the middle of the day, you see something on the news, or you see the market taking off, and all of a sudden you get this urge to buy, and you start breaking your rules and chasing stocks and doing things that you shouldn't be doing. This is probably the most prevalent, mistake that I can come up with. And what I like to say is, go in and don't call audibles. Try not to come in with a plan. Come into the day with a plan and stick to that plan. It may not be a great plan, but any plan is better than no plan. Go in with a plan, execute the plan, then at the end of the day, take a look at what you did, and then evaluate it, and then you come in with a new plan. But but it's when you call these audibles. And for those of you that don't know what an audible is, it's a term that you would recognize from football, where the quarterback has the option to, at the last minute, when he sees the defense shifting, to call a play right off the top of his head and basically change the offense. This is something that you want to avoid. And even myself, I've been doing this for 37 years, and I try to never call audibles. When I come into the day, I already know the stocks that I'm looking at, the stocks that are on my buy alert list, the stocks that I'm going to buy, what price I'm going to buy them, where I'm going to sell them if they move against me. Once I buy them, I have it all planned out, and I'm not going in the middle of all of a sudden seeing something and randomly running my stock screens or seeing something on TV and then jumping into a stock. That's not going to happen. I've got it all planned out, and each day is very methodically planned out the day before. How about you, Dave? I mean,
my best work. I mean, I love Sundays where the market's not open, and I've got hours to go through as many stocks, hundreds and hundreds of stocks, looking for setups, looking for stocks that meet the characteristics I look for, and setting alerts and alerts that will go off when they're hit, and having a list on my a list of the stocks that I'm looking at closely. And then also creating lists on my platform so I can so I'm ready. I can be looking at those things that are ready to go and ready to break out or pull back to spots where I want to buy them. So yeah, it's all set, as you said, before the market opens, where you're not getting bombarded with information and such. That's the best time to plan your trading day.
Yeah, a lot of people, they spend so much time on trying to learn what to do, and they read books, and then they don't apply the discipline to actually follow it. So you can have the best plan, you can have the best strategy, the best rules, and if you don't follow them, it really doesn't matter. So first you gotta have good rules, and you have to have a plan, but then you have to have the discipline to follow it. And the thing is, it's going to be another trading day. Tomorrow's another day. I assure you the market will be here long after you're long gone, and for many, many years after. There's always another trade. It's not no one day is going to make or break your investment return for the year or any one month. So just try to form a plan, go with a plan, and then execute that plan, and then come back, take a look at it at the end of the day, evaluate it, and then make a new plan, and you'll be much more likely to be able to do things intelligently and more methodically. All right, let's move on. So the second, and this is something that I did quite a bit early on. I made every mistake you could think of. So some of you might think that I was some born natural trader, that I have some innate skill or something that I was born with, but nothing could be further from the truth. I was actually, if I would use the word unnatural, I was an unnatural. I was the worst trader. I made every mistake that you could possibly think of, and it took me a long, long time to work it out, to get myself where I was consistent, and I was consistently making good decisions and making quality choices. It took a long time. But chasing stocks extended, and this could be anything. I mean, maybe your strategy isn't buying breakouts. Maybe it's a value strategy. You're buying stocks that are selling off. But it could be anything where you're paying beyond and chasing your stocks beyond the proper buy point. What I was doing for many years is the stock would move, and because I didn't have the skill yet to recognize it right at the right point, or the confidence to pull the trigger, then once it became obvious, and I know a lot of you can relate to this, once the stock moved up and it became obvious, and now you see the stock's up, the volume's coming in, and it's breaking out, and it's clear, now I go and buy it, and now I'm paying too much, and then the stock pulls back, and it's not a natural pullback, and I get stopped out of it because my stop was hit. So again, not chasing the stocks and really buying them just as they're moving through your buy points, and then leaving them alone. If they get extended, you got to leave them alone and let them go. If you miss it, you just let it go. Sometimes they gap. Sometimes you get a gap, and you get nerve. You get, again, that fear of missing out comes, and you go in there and you chase it up, and you end up paying too much. Dave, is this a mistake that you made early on?
Yes, and this is when I said that I doubled an account and then I lost that whole gain back. I took an entire weekend. This was 82 through 83. I doubled an account, and then from 83 to 84, I lost it all back, and I spent an entire weekend cutting out every chart of every stock that I bought. And the number one pattern, the number one mistake I made was chasing and buying extended stocks, and I just got I would keep my losses small, but I just kept on buying extended stocks and getting chopped up. The one thing you have to think about is that if you're buying a stock or a stock gets extended on you, and it's going to be a great stock, you've got to know that this stock is going to move for a year and a half or 2 years, and so you'll get another chance to buy it. Maybe you miss the first move, but you can get the second move, or you can get the third move. So you don't have to get so upset about missing a stock. If it's going to make a long move, it'll give you another chance.
Yeah, many times, I've traded stocks where they've just built base after base after base. Certainly, any of the big FANG names certainly could qualify for that. An Amazon or a Netflix, where you've had so many opportunities to buy it along these big secular moves. Yahoo comes to mind. When I bought it in '97 and Amazon in '97, they marched higher and made. Yahoo went up 8,000%, and I had traded it a whole bunch of times. I made 100% one time, 60%, another time 30%, and along the way, I've had a really good return in Yahoo. But again, if you miss that first base, you might catch some other ones. Interesting though, Dave. So you were having trouble, between, you said 82 and 84, and then you studied your mistakes. So didn't you win the U.S. Investing Championship 3 times in a row? Wasn't it? Was it 85, 86, and 87?
Yes, and that's because I learned. I looked. I admitted, and it's hard to do. It's hard to do some self-examination and see where you're wrong, but you have to do it because you'll find patterns that you probably just didn't know exist in your trading that will show up when you study your mistakes. And so yes, it was 85, 86, and it's 87, and that's because I learned from where I was losing money.
Interesting. So number 3, and again, I'm going to show you how this is not just, when I say trading too large, and we've often called it the pillow factor, or trading down to the sleeping point, where if your trading is getting you so nervous and where you can't sleep at night, and you're so scared to hold the position overnight or even intraday, you're probably trading too large. Now, there's 2 ways you could be trading too large. One is mathematically, and that's really, really important, because if you're not dialed in correctly on the position sizing, well then you're either going to be taking too much risk, or you're not going to be taking enough risk at all. So if you're taking too much risk, what happens is then you run the risk of blowing up or having a major drawdown, because what's called the risk of ruin. If you started getting a losing streak because you're taking too much risk of total equity, you're going to have a big drawdown. Now, if you're not taking enough, well then even when you have a winning streak, you're not going to make a whole lot of money, and maybe you won't lose much, when you're not doing well, but you won't make much. So return on total equity is the key number. Now, I don't have time today to go into, and you can certainly read in my book, Think and Trade Like a Champion in particular, as a position sizing chapter, and I explain this in more detail, and certainly in the Master Trader program, we go over this for a long time. But the return on total equity is simply the percentage that you're going to risk of your total equity of your account. And I'll give you just a perfect example. If you were to have a 25% position, and you were to take a 10% stop, 10% of 25 would be 2.5. That would be 2.5% of your total equity. That's generally speaking, that's too much. 2.5% is for absolute pros. Matter of fact, that's the max you ever want to go, would be 2.5% of total equity. And so then again, if you were having a 12.5% position, it would take a 20% stop to get to that. And if you were to have if you wanted to have 1.25% of total equity, then it would be a 5% stop on a 25% position. So you back into that risk based on position size and your stop, right? So where you want to be optimally is around 1 to 1.25, maybe 1.5%. You don't want to go much lower than 1% of total equity. If you start getting down to where it's a 0.5% or 1/4% of total equity, that's just not enough risk. So you're not gonna cash in when you do well. So that's the number that you want to dial in. Now, if you're just starting to get in the market or you're new at this, you might be taking very small positions just to sort of practice and start learning, and you can take those smaller positions and build up to that. And if you're just getting into the market from a bear market, going from cash, I often talk about pilot positions. Those would be small. Those might be 1/4%, 0.5% of total equity, and that you would just stick your toe in the water. But as soon as things started working, you'd move up to that optimal level. Now, yeah, go ahead. You have anything to say about the math?
I would add that if you're just starting out, I would actually take 80% of your money or 90% of your money and put it into a bank and get nothing out of it, but at least it's protected. The other 10% you can trade with because you're bound to make a lot of mistakes, and you want to make the mistakes with a very small amount of money. The other thing I was going to say in terms of trading too large, some people say, okay, what size position do you take when you're buying a stock? And that's something you have to determine on your own by, what is the size of your account? And I remember O'Neill would always say, well, if you only have $10,000, maybe you should have 2 or 3 positions maximum. If you get to 100,000, maybe you have a 4 or 5. If you have $1 million, maybe you get a little bit higher. But you still concentrate. But to me, I start usually with a 5% position and quickly go to a 10% if the stock starts working out. A position for me should only get up to 15 to 20% if I've already made some money in the stock. So you can get larger positions, but it's going to be done over time, and that's if you are taking longer term positions. If you're just swing trading or just trading just for a couple of days, then it might be a whole different a different size in terms of your positions.
Yeah, and also just on what Dave said about putting some of the money away and trading with a small amount. Now, a key point to that is to trade with a small amount of money, to actually trade with some real money. So paper trading, I just don't recommend for anybody, even for someone just starting out, because you just don't make the same decisions when it's fake money. That's why, contests, you go into these trading contests that it's fake money. To me, it doesn't mean anything, because I've noticed from my experience and from training hundreds, if not thousands, of traders over the years, you just don't make the same decisions. You need to have some of that emotional pressure on you, and that's where we go into the next type of trading too large, and that's emotionally. This is really sort of what trumps everything, because some people can trade real big and they can put everything up on the line and be comfortable with it, and there's others that they put just a small amount of money and they're just nervous as, what do they say, a long-tailed cat in rocking chairs, just so scared and so nervous. I've told this many times before, but we had someone come to our trading workshop a couple of years in a row, and after a couple of years, she came up to me and I said, "Wow," I said, "You've been coming for years. How are you doing in the market?" She goes, "I'm just about ready to make my first trade." So that's someone who's really so nervous that she's paralyzed, paralysis by analysis, if you will. So emotionally, that what we call the pillow factor, selling down to the sleeping point, that is definitely advised. Not only in the beginning, but even at a professional level, you really need to be able to trade within your own emotions, and that's what Dave is saying. It's really a personal decision, position sizing, but within the math. So if, again, and this is what I'm trying to point out, where even if you had a small amount of money, you still want to back into the math. So you can still have the correct math and have a position size small enough where it's not so big where you're an emotional wreck over it. The math would still have to make sense. So the 1% to 1.5% of total equity could still be on the smaller positions. All right, let's move on. So the next mistake, and this is one that is just, it got to be one of the absolute biggest mistakes that most people are making, particularly in a modern time frame, because we have armed everybody with a financial machine gun in their hands, smartphones, right, where we have access At one time, Dave, how cumbersome was it, back in the mid '80s to actually place a trade? I mean, remember how long we had a call, have a call back, and get it executed. I remember waiting 30 minutes to get an execution to know if I bought the stock or not.
Yeah, it was. I mean, you use a bunker remote terminal, and it would be very expensive to even get quotes, and then you'd have to pick up the phone. You call your broker calls the trading room calls the floor, and here now you can just push a button, and within a fraction of a second, you get a confirmation back of what you bought the stock at.
Yeah, and also, we have this power at our fingertips. So we've got news, and we've got social media, and we're bombarded with all this information. So there's a constant flow of stimulus that helps us to have that FOMO, and we're seeing everything. We're able to have such a visual view of what's going on. Again, we had I didn't have any quotes for years. I was doing everything to the newspaper and by hand and calling the broker. But even when I finally got quotes, it was just this blinking green light. You'd see, the bid and ask and the last trade, and that was it. There was no, real time, these charts and seeing everything, and financial news stations and social media. So you really are being tempted at all times. So you have to develop what I call sit out power. And that is where you can sit on your hands and you can wait and wait and wait, and that's where the forced trades. A lot of these rules are sort of cousins of the other rules. Like this over trading and developing sit out power is really a cousin of no forced trades, right? Not forcing trades, because forcing trades, if you're Machine Gun Kelly and popping off these trades, you're probably just doing trades and calling audibles and forcing trades. So again, developing that sit out power and discipline to wait for the right moment and the exact setup that you need to see for that entry point that meets your criteria. And this doesn't matter whether you're using my strategy, my criteria, or some other criteria. It really doesn't matter. Every strategy is going to have its set of rules. I mean, Warren Buffett has a set of variables. He has a set of variables that he is going to buy based on. So he waits for certain stocks to meet that criteria. Whether it's technical, fundamental, it doesn't really matter. But the bottom line is, as Jesse Livermore said, you can beat a horse race, but you can't beat the races. If you're in there trading every little thing and every move and trying to trade every day, you're going to have a real tough time. So,
and Mark, I would add that so many people think that you have to be in all the time. Oh, I have to be 100% invested, but there are times where you should be out and be out for months, because at least with what I'm using when I'm looking for growth stocks, and if all my growth stocks I've sold out because they've rolled over and I can't see anything setting up, I have to sit there in cash and I have to wait. I look for things to do. I go out in my backyard and I start gardening because if I sit in front of this screen and all these lights are flashing, and sometimes you'll make up a trade that it isn't really even there. So you have to have that attitude that you can be out of the market and you can hold cash for weeks or maybe even months.
I've held cash for over a year at times. There were times in the market in the 90s even, we had the rip-roaring bull market. But from mid-93 all the way almost to 95, I held cash and barely traded, or very small trades. Again, there's periods of time where you're going to sit back and you're just not going to have the stocks meeting the criteria. So again, not chasing your tail and over trading is key. So this next mistake, and I think this is really another one. And all of these are just so important, and I'm sure that almost all of you can relate to at least some of them, if not all of them, intimately. We've all made them, and every one of these mistakes. There's not a stock trader alive that hasn't made every single one of them and won't make them multiple times over their career. But what I found was, really focusing is very difficult for most people to really get and focus down to really specializing in one area. And when I first started training traders back when I used to manage money and had a hedge fund in New York City, when I started a trader to work for me, what I would do is I would narrow it down where they could only focus on one chart pattern, and it had to be in a small little window of relative strength. So it would be like 99 to 95 relative strength and one chart pattern. And I'd say, okay, let me see you become profitable with that, and run the screens and it would bring up, maybe it'd bring up 30, 40 names at any one time. That was your universe. You had to trade only that universe, make do with that, and let me see if you can make money with that. And then we'll expand the parameters, and maybe we'll add another chart pattern. That's the constructive type chart pattern, and we'll expand the parameters maybe to additional relative strength, and then we can start building in some other characteristics and expanding around that core competency. So what I find is that, and the real problem too, is what we call style drift. Style drift is when you're doing one thing, and then it's maybe you have some trouble there. It's not working so well. So now you try something else. And now 1 minute you're a swing trader, and now you're day trading, and then you're a value buyer because that's working, and you're all over the place. And what ends up happening is you just become a mediocre at a whole bunch of things, and you never become really great at one thing. People ask me all the time, what about this? What about that strategy or this indicator? And my answer is always the same. I don't know anything about anything else. I don't know anything about that particular strategy, but I know everything about my strategy. I know my strategy. Yeah, go ahead.
Also, there's a lot of people who they buy and sell stocks, but then they also do options, and then they do futures, and they're doing commodities, and they're all over the place, and they're not doing one thing exactly and doing one thing well. So I would say if you're trying to do all these different markets and different time zones and things like that, I would say, hey, just focus, just get in onto one style and stick with it. When I was running my hedge fund, one investor called it, you've got a very plain vanilla hedge fund. That's because I only bought stocks, I sold stocks, I shorted stocks sometimes, and I rarely did options to hedge my portfolio, and that was it. And that's all I did, and that's all I concentrated on.
The real word that I would say that's important here is unnecessary. You see, it's not necessary to be all over the place. I started with a very small amount of money, just a couple $1,000s. I built it up, and over years and years, and meticulously trading, I built that into a fortune that I don't ever have to work again and worry about money. Well, guess what? I'm doing the same thing today as I did 30 years ago. I haven't changed my style. I haven't used other styles. I haven't added options or futures. I'm still just trading stocks from breakouts, from bases, exactly what I was doing 30 years ago. I'm better at it. I'm better. I get better all the time. 30 years later, I guess I should be better at it after 30 years. So again, it's unnecessary to get to the goal. If your goal is to build your wealth, and my goal was to be great at a particular style, a strategy. I wanted to be a great trader at the style that I was doing, and I knew the money would just come. I didn't even really think about the money. In the beginning I did, but I said, heck with the money, I'm gonna be the best in the world at this. And if I even fall anywhere near that goal, I know the money's gonna come. But I really, really honed it down to one particular way. And there's been times where that style has been out of vogue, it's been out of favor, and I had to sit back and I had to watch a whole bunch of other people and methodologies do well, and I didn't switch. I stayed because that was the time. That's part of it. Part of it is the ebbs and flows. All right, we don't have time to go in deep in all this stuff, but we're gonna touch upon each mistake here. So the next one is number 6 is not nailing down decent gains when you have them. This was again one that I made early on, and in particular, this sort of stems or sort of happens in a couple different ways. One is giving back profits. So you buy a stock, you're up 20%, right? Now it comes down, you're up 15. Now you're up 10, and before you know it, you let it come all the way back, and you're up 4 or 5%, and then you say, well, there's no sense now. I gave back almost everything, and of course you're wishing you sold when it was up 20 now, right? You're kicking yourself, and now it comes all the way back down, and now you're flat, and you gave everything back. So that's one scenario. A much worse scenario is to then allow that to turn into a loss. And now it goes into a loss. Nothing's more demoralizing than having a great gain and then having it go into the loss column. So letting a good sized gain turn into a loss. I did that. I can't even count how many times early on. That was sort of, a key thing that I learned by going back and looking at my trades post analysis. I said, I got to come up with some way to protect these gains. Let me tell you why that happens, though. That happens because you don't really have a plan, and you're not really thinking what trading is about. Trading is about making more than you risk and doing it over and over. It's not about getting the high. It's not about a set number of whether it's 100%, 500%, finding the next Amazon. That's not what trading is about. If that's what you're focused on, you're going to be disappointed, and you're going to constantly be chasing your tail, because the goal of trading, it's all probabilities. It's all about managing the risk-reward relationship and nailing down profits in relation to your risk and having an edge there. So a couple ways you can do that, and again, maybe I should even, before I even talk about the solution, Dave, so again, going back, to your, certainly in the beginning. Now, keep in mind, I was there in the beginning stage, in the beginning days when David was a young guy, trading, just when he won the U.S. Investing Championship. I read Market Wizards, and I went to O'Neill seminars, and I read about David in the Wall Street Journal when he won the U.S. Investing Championship. So this was the time where he was going through his tough period and just had worked it out and started doing really well. Looking back, Dave, is this a mistake that you made?
Well, when I had those 3 years in a row, I actually I was fairly concentrated. I had probably 3 or 4 stocks, and I would, when one would take off, then it would be a 20 or 30% position, maybe even more for a short period of time. But when it had a really nice run, and then looked like it was starting to stall, then I would sell most of that down and move it into another stock that was just taking off. So I would be constantly moving my money, taking my gains, and sometimes I would leave a small amount in that first stock, because then when it sets up again, I'm much more likely to keep an eye on it and buy it back on its second move. So, but I was taking gains after nice runs and just moving the money to the next one.
Yeah, I had no idea. I spent so much time trying to learn how to buy a stock that once it took off and had a nice gain, I was like surprised. I was like, what do I do now? I didn't plan for this. I was just so concentrated on what to buy, when to buy it. I didn't even think about what I was going to do once I had a nice gain, how I was going to handle that, because that actually becomes an even more difficult decision. That's, your stop loss is sort of, a number that you just sort of, draw into the line in the sand, and that's it. It's an absolute number. But selling at a profit, that's where you really start getting into this indecisiveness. I always say, traders live between 2 emotions: indecisiveness and regret. Indecisiveness: should I buy? Should I sell? Should I hold? Regret: I should have bought. I should have held. I should have sold. When we sell the stock, you see what happens afterwards, and very often it goes higher. And very often when we cut a loss, it turns around and goes back up, and you say, "Oh, I should have done this. I should have done that." Well, again, this comes down to realizing what trading is about. Like Dave said, he was using forced displacement. He'd take that money, move it into another stock, just moving, and take those profits, because that's where all his returns started changing, and he won the U.S. Investing Championships, because now he's nailed down those profits. You got to nail down the profits. And the other thing too is do the math. I always say do the math. You'd be surprised what 10, 15%, 20% profits can do if you compound those and you have decent sized positioning. A lot of people are saying, how is Minervini making these big returns? Well, because I'm compounding and I'm moving the money very rapidly. I'm taking the gains very quickly, and I'm constantly compounding. I'm doing exactly what David said. I'm shifting the money from one place and moving it to the next stock, moving and nailing those profits down. Now, one way that you can do this is that you can backstop. So stock goes up, and say it's up 20%. You don't want to give that all the way back. So now you can even come up with an arbitrary number. Say 15%. You put a stop at 15%. Not a trailing stop, a backstop. A backstop just sits at that one level. Now the stock goes up a little bit more. It's up 25. You move it to 20. Maybe it goes up more. And you keep moving your backstop. So now you've made a decision. This is the amount that I'm not willing to give back, and I'm going to draw that line in the sand. Now, again, a cousin to this would be not protecting your break-even point. Really important is protecting your what we call your line, your break-even point. And that the reason why is because once you go below the break-even point, you're losing your original principal that you went into the stock, right? So stock runs up, and now it's up, let's just say 20%. You don't ever want to let that turn into a loss. You should never let. This is something I learned from O'Neill. I had a conversation with O'Neill, and we talked about trades that I was doing, and he said, the rule that I have is to never let a big gain turn into a loss. No matter what, even if it's a 50% gain, if I allow it to come all the way back down and hit break even, I'm out. There's no way I'm letting this nice gain that I had at one time turn into a loss. And that's been key for me. Now, the other thing that I see when I tell people to do that is then they get so tight that they move the stop up to their break even too soon. So now the stock goes up 2% and they move it to break even and they get stopped out. So there is a balance there. You need to backstop your profits and protect your break even, but not choke the trade off. So this is more this is more for when you have a decent gain. Then you start moving up your stop to backstop and protecting your break even. Not if the stock just moves up and it's up a couple percent, because 50%, 60% of stocks that break out will come back and they'll undercut the breakout point. So you're getting stopped out too soon. Dave, any words on protecting break even? How do you? Is there any general rules of thumb that you have for protecting break even?
Well, I use when a stock moves up and I've got a nice gain on it, I don't move up my stop on a set percentage basis. I usually use the technicals in terms of where I'm going to protect that gain. And I look for trend lines, I look for moving averages, or just the technical setup of the stock. So it's not a set. It's not like the stock moves up 10%, I move up my stop to 5%. I use other things once the stock is up and going. On my initial purchase, I'm always looking at 8% as a stop loss, and most of my losses are coming a lot sooner than 8%.
Right, and I'm using the technicals too, but I can tell you right now that I'm aware of the math behind my trading at all times. I'm always aware of the math. So, I know that if my gain, even if the technicals, the stock moves up here and maybe, it's not looking too good, and it starts coming back in on me, but I'm still up, maybe 4% or 3 or 4%. I'm probably not going to sell the stock and take a 3 or 4% profit, because I take a look and I see, my average, my stop is 5, 6, 7, 8%. I have to take gains that are a multiple of that. So I probably give it maybe to my break even or my full stop. So I'm always aware of the math. And a lot of times I'm going to make that decision purely on math, but you want to back into. So when you're using the technicals, you want to back into the math. So even when you're looking at a stock, say you're using the technicals for your stop loss, you say, I don't want it to, this is the level where the stock trade would sour. This is where the chart would sour. Okay, now figure out what's the math behind that. So if you're looking at the technicals, and again, if you go back and you look at Dave's trades, I mean, he's going to intuitively stay within his math. He's been doing it long enough where you're going to go back and you're not going to see where his math is upside down, where his average gain is 5%, his average loss is 12. That's not going to happen. So you might not have that kind of, intuitive feel in the beginning. You definitely won't. And you're going to need to be aware of the math behind that. So you're back into that. Now, that stop loss below that technical floor, if you will, is 15% away. And you go back and you look at your gains, your average gain is 5%. Well, that doesn't make mathematical sense, right? So you're going to have to back into those charts. Again, we can't go into this in depth, but I just want to give you go through the mistakes here. So number 8, not using progressive exposure properly. So for those of you that don't know what the term progressive exposure is, this is something that I coined, and it basically I didn't coin the concept, but the phrase progressive exposure it has sort of caught on over the years, and now a lot of people are talking about progressive exposure. However, it's very often misunderstood, and usually it's done improperly, or it's done too slowly. That's another mistake that happens. So progressive exposure just simply means that you're starting with a relatively small exposure and small, what I call pilot buys, when you're first getting into the market, say from cash or from a bear market, because you don't know yet if the market is indeed healthy, if the stocks are working, if your ideas and your opinion or your analysis is actually working in the market, and if the themes is actually bearing fruit. So you put some money in the market. If it's working, great, and you start getting some traction, now you can put some more money to work. And again, the basic rule is when I get into the market, from cash, it could be off of a correction or a bear market, I usually put 25% or so into maybe a couple names, and I see if they're working. If they start working and I see some profits, I move quickly up to 50%, and if that starts working, then I get aggressive and I start moving 75, 100, and I might even use leverage. But it's not until I see those initial pilot buys working and that smaller exposure, I never just jump right to fully invested. Never. I never do that ever coming from a cash position. And on the opposite side, if things aren't working and I'm getting stopped out repeatedly, I go down. I go right into a cash position, or I go from, if I'm at 50%, I'll pull back to 25. Still not working, I'll pull back to 5 or 10, and I'll go into cash, and then I'll watch for a while and see if things start gaining traction again. So you're increasing your exposure when trading is working, and you're decreasing it when it's not. What this does is, think about this, okay? This is really key. You want a system that guarantees you to be trading the largest when you're trading your best and the smallest when you're trading your worst. And the way to do that is to bend in each direction. Okay? So Dave, I know for a fact that you use progressive exposure, and that you're certainly not jumping in with both feet right off the hop here. Any general rules of thumb?
Generals, I'll just give an example from the current market. In the last couple of months, maybe even the last 6 weeks, a lot of stocks have tried to break out. They break out and they're failing. So I started, when I had 2 or 3 of these stocks do that on me, then I started getting smaller positions, more money out of the market, and then I was trying pullbacks, and some of the pullbacks just kept on pulling back farther, and so that wasn't working. And so when I experience that type of trading, and things are just not working, I get smaller and smaller and smaller to the point where I'm out of the market and waiting until I see setups are starting to work. So that's pulling back your exposure as things don't work, and you shouldn't start getting more aggressive or say, oh, if only I get the next stock. If things aren't working, they're not working, and there's nothing you can do until the market changes and starts rallying for you. But you kind of, as O'Neill would always say, you bend with the wind, you bend with the way the market is moving.
And Dave, when you get super aggressive, when you're most aggressive, and you're really taking your biggest positions and you've got your biggest exposure on, how does that come about?
Well, that's when I see stocks breaking out all over the place, and I've got stocks that are working. I just keep on adding money to the market as I see more and more stocks breaking out. And they don't all break out. It's not all, it happens all in one day. I remember studying recommendations that O'Neill and Company made, and there were a lot of them before the market actually started turning, and a lot after the market started turning. So you do it as you say, progressively. You get more and more money into the market as things are starting to work.
Right, right. And I should also point out, of course, we talked about David Ryan. He won the U.S. Investing Championship 3 years in a row. I won the U.S. Investing Championship in '97, and I'm in it this year in 2021. David's son also is doing pretty well in the U.S. Last I saw, I think he was up 60%. And in this particular market, that's a heck of a return. This has been a very tough year. So David's son is also doing very well. Sean Ryan, who I know personally and is a really talented trader. And many of you also, we have many of our clients that are in the U.S. Investing Championship. Matter of fact, in the top 20 or 30, we've got a good number of people that are members of ours and friends of ours. So I just wanted to mention that and say good luck to everybody. It's we're seeing some people doing really well in this market, and it's been tough. All right, so number 9, and this is without a doubt the biggest mistake made by all investors, professionals included. As a matter of fact, believe it or not, there's a lot more professionals that make this mistake than you would ever believe. So, not cutting losses, and certainly not cutting the losses at a mathematical level that makes sense based on your expected gain. Losses are a function of expected gain. If you're taking losses that are bigger, trading is a very simple. It's a very simple business. It's no different than any other business. If you own, a dress shop, you'd buy a bunch of dresses and you'd pay up one price for them. You'd mark them up and sell them for a higher price and make the difference, right? And dresses that didn't sell, you would mark down and you would get rid of them, and some of them you would take a loss on even and put them on the clearance rack. Same thing with stocks. No different. You're buying merchandise, you're looking to sell it higher, and if it doesn't go higher, unlike the dress, with stocks, these stocks can go down precipitously. And again, if you were to make a mistake and buy a whole bunch of dresses that and take this big inventory in and not sell it and just let it not cut your loss on that inventory, it would be the same thing as holding a stock, right? The law of business, or the law of supply demand, the law of risk reward relationship is no different in regular business dynamics than it is in the stock market. You've got to manage the risk, and even worse. I like to put it in terms of like I said, with merchandise like in a store, because if you were a store owner and you bought these dresses, right? You bought blue dresses, red dresses, and yellow dresses. And the red dresses and the blue dresses were selling like hotcakes, but the yellow dresses didn't sell at all. You didn't sell a single one. Would you buy more of them? Would you go and load the boat on those? No, right? And say, well, I think, they might sell in the future, and I'm going to buy a whole bunch more because I'm hoping that those go up, or I can't get any more of those blue or those red dresses, so I'm going to buy a whole bunch of yellow dresses. No, you'd be out of business pretty quickly. That's precisely what stock traders do. They buy more. Stock's down, so their broker tells them, you got to average down. You got to lower your average cost. Now, if the stock goes back up, you'll get it back twice as fast, right? That's how you blow up. You're adding good money after bad and getting heavier, and you're not only not cutting your loss, but you're also defying the rule of progressive exposure. So now this also happens when people get into a losing situation. They start losing on some trades. They try to revenge trade. They want to get it back quick because they're so upset that they lost the money. You got to keep your head. You got to stay cool. You keep your losses small, and then you try to build back slowly. Dave, now I'm sure, just like myself and all of us, at some point you must have been caught and got a losing streak, or got hit big on a stock and got yourself in a situation that you weren't too happy with. I mean, are you ever going to double up and start trading real big to try to get out of that hole quickly? And how once you start getting into that situation where you're getting hit on losses, what is your response? How are you responding to that?
My response is just to sell. I hate having really any loss in my portfolio, and they usually don't stay around long if they're in the red on me. And the thing about this, comes down to discipline. As you get before you make your investment, you have to set your stop of where you're going to be selling the stock out or whatever you're investing in. Because once it starts down, if you don't have a definite stop point, then it's amazing how much the mind can rationalize. I don't know where I've got this quote from, but it says like man has an infinite capacity to rationalize, and you can come up with almost any excuse in the book why you should continue to own the stock, but the number one reason why you shouldn't own the stock is because it's gone through your stop point, and that's why you have to stick to those stop points. But you might live right next door to the CEO of the company. That's not an excuse to keep on holding the stock if it goes through your 8% stop. So just don't start rationalizing and coming up with excuses of why you should continue to own that investment.
Incidentally, the worst advice I ever got was from CEOs of companies, just to let you know. So that's the worst place you want to ever ask is the CEO of the company, because he's certainly not going to say anything bad about the company. but anyway, so the question that I often get, Dave, when we start talking about cutting losses, is what happens if it actually gaps through your stop and you set a 8%, and now you're very quickly it cascades through and you're down 12 or 15%. Then a lot of people, what they'll do is they'll wait and they'll say, well, I'll wait till it comes back to 8% and then I'll sell, and that's where the real trouble starts, huh?
No, yeah, and usually I might give it some time intraday. I usually, if a stock gaps down, and I look for the first 10 or 15 minutes, maybe the stock starts coming back. If it doesn't, and if it goes through that low, I'm out of that stock, because for it to gap down must be some pretty bad news. And I'm already at a greater loss than I wanted. And it happens. It happens sometimes in an earnings report, and there's nothing you can do about it. You just take your loss and move on, because usually those losses just get worse and worse.
Yeah, I have what I call the 5-second rule. So stock gaps through my stop. I literally watch it for 5 seconds. If in those 5 seconds it doesn't recover and move up from there, I sell it immediately. And if it does, I set a stop at the low prior to those 5 seconds. So let's just say the stock gaps down. It gaps down, it's down 12%. It rallies back. It's in just a couple seconds right off the hop. It comes right back. It's down 11.5%. 12%, I put a stop right there. I sell right there because it was already there. That's where you would have gotten out. So I'm not losing anything. That little quick snap back has basically got me to the good 0.5%, but I don't want to go any more than where I already would have got out on the open. And it's intraday now, so I don't have to worry about that overnight gap. You do have the risk of if it got halted, so that's another risk. If you don't sell, they could halt the stock, but it's very rare, and that's how I handle it. That's the only caveat I would say to if it goes through your stop. Otherwise, I'm just out. I mean, I'm out right as soon as the stock trades at that price. As soon as it goes through my stop, I'm out. No questions asked. All right. So number 10 is unrealistic expectations, and I want to make sure that I make this clear that I'm not saying unrealistic expectations with how much you can make. As a matter of fact, you should have the expectations that if you're willing to put in the work and you're willing to study and put in the time and unconditionally commit to becoming great at stock trading, your expectations are way too low, way too low. Your potential is way higher than you probably think for yourself and for the market. There's way more potential than you could possibly imagine. When I first started trading, my goal, when I first started trading in 1983, my big goal, my big long-term goal was to make $500 a week trading. That was my goal. My goal was, boy, if I can make $500 a week, this would be unbelievable. This would be, I'd be there. That was my big giant goal. And of course, that, looking back, that was a little tiny goal. I had much more potential than that. But when I say unrealistic expectations, what people underestimate is how long it's going to take for them to get to that level where they can make that big money, those big returns, and be really proficient at this. And that's not going to be 4 or 5 or 12 months. It's going to be 4 or 5 or 12 years. Okay, and that's where you have to realize that, again, people come into this profession with such disrespect. I mean, would you ever go into brain surgery or trial law or becoming a baseball player or a basketball player and think that you were going to go to the major leagues or try a murder case or do brain surgery in a few months or even a year or two? No, that would be absurd, right? But for some reason, you open a brokerage account and you think that you should be trading just as good as David Ryan or Mark Minervini or whoever is someone that you look up to in a few short months or a few short years. It just doesn't work that way. Even if you are doing well in a few short months, trust me, there's luck is on your side at that point because you just don't have the skill yet to be able to be consistent. So it's going to take time. It's going to take time, and that learning curve. Here's the good news. The good news is that the learning curve is shorter than ever. It's amazing what you have available right now. Like I actually tweeted this today, where when I started, I had the library. That's where I spent my time. I went to the local library and I read books on strategies that never worked in the first place. I mean, it took so long to find the information you had to figure everything out on your own. To everything. I traded the drums. Many of you know I was a drummer. And you had to get the album and put the needle back 500 times and listen to the part over and over and learn it. Now you go on YouTube and the guy who wrote the part plays it for you right there and teaches you. And you have this. You're being taught by David and I. Your learning curve is way shorter, but it's still the one thing that you can't force and you can't shorten is experience. You have to get the experience, and it takes years. It takes years. So don't get down on yourself and quit if you're having a tough time and you're not a super trader, in the next 12 months or 24 months. There's a process and there's a learning curve. Dave, you went through this learning curve even earlier than me. So when the further we go back, we go back to Jesse Livermore. He was trading in bucket shops and reading ticker tapes. But somehow they prevailed. He prevailed and was able to make hundreds of millions of dollars. So what do you see as far as this new age? We've got so much information, but we also have information overload now, right? Where there's so much information, you have to decipher who to listen to.
Yeah, you have to find methods that work, and Can Slim and O'Neill process and what you've taught, has not changed. And the stocks that had great moves in the 1920s and 30s look like the exact same stocks that have the big moves today. And it's finding the right set of rules to work with, and then getting to know them extremely well, and spending a lot of time to learn that process. And as you said, it takes a while, but it takes a long time to learn almost anything. They talk about 10,000 hours to get proficient in a sport or an occupation. The other thing I would also say in terms of unrealistic expectations is the market that occurred last year. Was to me very unrealistic. That's a market where a confluence of events comes in, and it only happens once every 20 years. This happened in 2020. It happened in 1999 into 2000. It happened in 1982 and into 1983, where you had a huge explosion in the market, and all these stocks went up, and everybody made money. I think 95% of all stocks last year went up or made money. So coming into this year, it's now gotten harder. It's gotten rockier. The breakouts aren't working. Things aren't working as well as, and it seemed so easy last year. Well, you got to study the markets, and you'll find there are a lot of years where it can be very, very choppy, or it can just roll over and die. So you have to have rules to operate, and the rules that we're teaching are the rules that have worked and should continue to work. And you just you have to learn it and put in the time.
Yeah, And the key is to make hay while you may and make the big returns when things are good, and then you can afford to sit out and you can wait. Mark Ritchie, of course, many of you know from Momentum Masters, who works with us at Minervini Private Access. Last year was his big year. He did great. He was up, I can't remember the number, but it was over 300% and multi-millions of dollars. I've had years where I was up 400% in 1 year, stretch of years where up, triple-digit returns for multiple years. That's the goal, is to make the big returns and then sit back and wait for those opportunities, which I assure you will present themselves. But the key is that you need to be prepared for when that opportunity comes. And you may not, those opportunities, that initial opportunity may not overlap with your initial entry into the market. When I say initial, I'm talking about the first couple of years. You might be in your second or third year and that opportunity comes, but you're not really prepared to take advantage of it fully. And later on, you'll look back and see, oh, wow, I could have made a ton of money then. I just didn't know how, I didn't treat it properly. But you'll get the next one, or maybe the next one after that, and then you won't miss them anymore. I look back, and I did very well in the 90s. But if I knew what I know now, in the early 90s, I probably would have made several $100 million then. I made a lot of money, but again, I look back and, we're always like, we look back when for those of you that are, 50 in your 50s now, you look back and go, oh my God, how naive I was at 30. And probably at 70, I'll be saying that about being 50. We look back and because we're always growing and getting better and learning more. Let's move on to the next mistake here. And this is one that we find that every time we have a master trader program, I always ask, and of course we've done it for 10 years in person. We've recently done it online because of COVID. But I ask for a show of hands, and I say, how many people right now know their trading stats? They know their average gain, their average loss, their percentage of trades profitable, average days that they've held their gains, average days they held their losses, largest loss in any month, largest gain in any month. Show of hands. Usually about 5%, 10% of the hands go up. That's it. Recently, it's been a little bit more. Maybe you can bump that to 15 or 20%. But way more than half, if not 2/3 to 70, 80%, don't know the math behind their trading. And this, just very basically, again, this is something that when I tell you I get into this in depth at the Master Trader Program, and we talk about this quite a bit on a weekly basis on our platform, this is something that I really has been probably made all the difference to my trading, is that I'm so aware of the math. And when I go into any trade, I let the spreadsheet, the math from the spreadsheet work its way into my trading, where I'm always trading I always maintain my edge, that reward to risk ratio. I'm always thinking of reward to risk. So very simply, just to start off, to know your basic numbers would be your average gain, your average loss, and your batting average, which is the percentage of trades that are profitable. So if you had 100 trades and 50 of them were gainers and 50 of them were losers, you have a 50% batting average. And if you had an average gain of say 10% and you had a loss of 5% and you were right 50% of the time, you would have a 2-to-1 risk reward, right? So you'd be making $2 for every dollar you risk. Now, if your batting average falls below 50%, well then your risk reward is going to change. So let's just say your batting average goes down to 40%. So now out of 100 trades, you're only right 40 of those trades, and 60 of those trades you lose money. Well now, and to maintain that same 2-to-1, you'd have to have a 3-to-1 on your reward to risk. So now if you had a 15% gain on average, and you had a 5% loss on average, that would be 3-to-1. You adjust that for the 40%, 60%, it would still be 2-to-1. So you want to try to maintain at least a 2-to-1. I want a 2.
Sorry. That was my briefing going off.
Gotcha. So you want to maintain, I like to maintain a 2-to-1 to a 3-to-1 ratio, and I'm always aware of that number. Now here's why. Let's just say, again, we're going to go back to Dave where he's, using that technical out for the stop loss. So we go in there and we say, okay, this is the technical level, and that level is at, let's just say, 10%, right? But you look back and you see that your average gain that you're getting on your gain side is 6%, and your batting average is 50%. Well, guess what? You're a losing trader now. With that, if those are the type of losses that you're taking, and you're going to take a 10% loss, but you're only averaging 6%, that math doesn't make any sense. So the first thing you have to do is know the truth about your trading. What is going on in your trading? And that information is going to tell you a lot. Not only does it tell you, because some people go back, they do their math, and they go, oh my God, my average gain is 3%. What am I going to do? Cut my losses at 1.5%? No, you've got another problem. Your problem is that you don't have a very large average gain, which probably means that you're not allowing the stocks to come to fruition. You're selling them too soon, you're choking them off, or maybe the market's really bad and it's a very tough environment and nothing's following through. You're going to get a lot of information that's going to tell you a lot about your trading and a lot about the environment, and then you can make those adjustments. So that's a starting point. That's a starting point. It gets much more advanced than this, and again, I have the time to go into this now, and you can learn more about it in my books. And certainly, as we pointed out, the Master Trader Program is coming up in November. Real quick, the amazing thing about, I have to say this about the Master Trader Program, because first of all, I've been working with David now for, 7 or 8 years now, and David was someone who I looked up to 30 years ago. So to be working with him and passing the torch really is an amazing thing for me. It was the first year that I did it. I was elated when David wrote the foreword to my book. That was a big thing for me. So to be working with him now for almost a decade and teaching it's been a thrill every year. It's like every time I used to look at New York City when I lived in New York City, it would impress me every time. It still impresses me, and we've taken this to another level here where it's really quite amazing. This year we're going to have the Market Wizards books, notwithstanding the version that I'm in. The previous two books, 1 and 2, were like my Bibles. I mean, this is where I read those over and over and over and over. And some of Larry Height was someone who I loved and was really responsible for a lot of the risk management techniques that I use today. And this year, Larry Height is one of our guests. He's going to be a guest instructor. Tom Basso, who's just a wonderful guy and a super, super bright guy. He really comes from more of an engineering side. He's really an amazing guy in Market Wizards too. He's an instructor. Stan Weinstein, for those of you who know, I met Stan Weinstein in 1990, and he wrote the book about the 4 stages of a stock cycle. That's where the stage 2 uptrend came from with me. It started with my meeting with Stan Weinstein and reading his book. He's going to be an instructor, and then of course Mark Ritchie, who is sort of a new age market wizard. He's in Momentum Masters and works with me now on a daily basis. And Mark's amazing. He's had huge returns. He's also going to be one of the instructors. So it's really an amazing event. And then we have Arusha Paris from MarketSmith, who every year I learn something new about MarketSmith. I don't know, Dave, I don't know if you learned anything, but the last 2 years I learned all these nifty little tricks on how to use MarketSmith. It's such a powerful tool. David and I have been using, David actually created many of the things that are on MarketSmith, and I've been using MarketSmith in one form or another for 25 years, 30 years now. It was first Daily Graphs printed, then Daily Graphs online, and now MarketSmith, of course. So just so much to learn, and just an amazing week coming up. Dave, any final words here?
I think I saw somebody ask, well, will this cut the time that I get up to speed? And the amount of information that you're receiving I wish I had this when I was starting, because it answers a lot of questions and just kind of gives you a roadmap of what to be looking at and what to be studying and how to become a better investor. And I think it's going to cut off the time and the pain that a lot of investors have to go through if they go through this course, because this takes, when we do this live, we start on Friday, and it's all day Saturday, Sunday, and Monday, and there's so much material, and I think it's just can only help someone get more more up to speed on what to, exactly how to trade.
Yeah, so I can tell you this, that if you're, now everybody's different. Everybody has a different amount of time. Some people take longer than others. But if your destiny was a 8-year learning curve, this is going to probably cut it down to a 4. If you were going to have a 4-year learning curve, you're probably going to have a 2 or 3. But I can tell you this, are you going to be a great trader overnight? No, because you got to get experience. You're going to still need. You can't force the experience. But we are absolutely going to cut down. Your knowledge base is going to come up from wherever it is to 100%, literally in that week. Now, there's the retention, and you going back and studying and taking workbooks home and using it. That's going to take the time where you're going to have to apply it. But we've seen amazing things. I've been doing this now. This is the 12th year, and the reason why I keep doing it is it's just every year it's just more and more people with amazing stories. And the most, when we did it in person for 10 years, and I wish we were still doing it in person, because prior to us starting this, we were talking about it, or I was talking actually to Arusha before, and just said some of the most beautiful people I've ever met in my life came at the Master Trader Program, because they come from all around the world. I don't even know how many, 70 countries now or so. So yeah, is it gonna lessen your learning curve? Absolutely. Today just shortened your learning curve probably amazingly. If I had this one session back in 1983, 84, I'm pretty sure I wouldn't have spent 6 years making those mistakes. It might have been maybe only 3 or 4 years. I don't know, but I know it would have shortened it. So I hope this has been helpful, and that you learned some things here today, and that you're going to go try to apply them. Again, we can only do so much in an hour and a half or so, but I want to wish you the best, and thank David Ryan for taking the time on this schedule. Appreciate it, Dave. And many of you will see soon at the in November. And for those of you that are Market Smith clients, I'm doing the podcast tomorrow, and I think it replays. There's an IBD podcast. I'm pretty sure that's for Market Smith only. I don't even know, to be honest with you, but I think it's for Market Smith only. But maybe it's not. Maybe it's public. But I am doing an IBD podcast tomorrow, which will be available to view on Thursday. Okay, so talk to you guys soon. Thanks for attending, and have a good rest of the day. Bye bye.